Unit 6: Sustainability and Ethics in Corporate Finance. This unit will explore the multifaceted concept of sustainability, examining its evolution, challenges, and implications for businesses and society. We will delve into the complexities of defining and measuring sustainability, exploring how organizations perceive and integrate sustainability into their core operations. The unit will examine the interplay between economic, social, and environmental factors, highlighting the importance of a holistic approach. We will analyze the relationship between sustainability practices and corporate financial performance, exploring various metrics and methodologies. The concept of ESG, environmental, social, and governance, will be examined in depth, including its impact on investment decisions, risk management, and stakeholder relations. The role of technology in advancing sustainability initiatives, such as the use of data analytics and reporting tools, will also be discussed. This topic will delve into the complex and evolving landscape of sustainability. We will examine the challenges associated with defining and measuring sustainability, exploring alternative frameworks and metrics. The topic will explore how organizations are responding to global sustainability challenges, examining the interplay between economic, social, and environmental factors. We will investigate the relationship between sustainability practices and corporate financial performance, including the role of ESG factors. Additionally, we will explore the integration of energy accounting and sustainable energy performance within the broader context of sustainability. Here's a summary of the document, Corporate Sustainability: The New Organizational Reality, by Upasana Danda and Vijay Kumar Shrotria. Summary. This literature review explores the evolving concept of corporate sustainability and the shift from traditional business models focused solely on shareholder profit to sustainable business models that integrate economic, social, and environmental concerns. Key points. Corporate sustainability defined. Corporate sustainability is now seen as essential for organizational longevity. It involves meeting present needs without compromising future generations, moving beyond compliance and philanthropy to a holistic approach that creates value for all stakeholders. Historical evolution. The journey began with companies focusing on philanthropy and minimal compliance. Over time, external pressures, social, environmental, regulatory, pushed organizations to embed sustainability into their core strategies, governance, and operations. Stakeholder engagement. Modern sustainability requires value creation for a broad set of stakeholders, including employees, customers, suppliers, shareholders, and the community. The shift from shareholder primacy to stakeholder value is driven by increased transparency, resource constraints, and societal expectations. Business model transformation. Sustainable business models, SBMs, go beyond profit maximization. They incorporate the triple bottom line: economic, social, environmental, and require changes in organizational culture, strategy, and partnerships. SBMs are characterized by value propositions, supply chain responsibility, customer engagement, and fair distribution of costs and benefits. Benefits of sustainability. Companies adopting sustainable strategies gain competitive advantages such as improved reputation, employee loyalty, operational efficiency, and long-term financial performance. Research gaps. The literature on corporate sustainability is fragmented, with inconsistent definitions and measures. There is a need for standardized conceptual frameworks, better integration between macro, societal, and micro-organizational sustainability, and clearer performance metrics. Future research directions. The paper calls for more empirical research on how organizations internalize sustainability, develop sustainable business models, and link organizational strategies with broader societal goals. Conclusion. Corporate sustainability is becoming the new organizational reality. Companies must embed sustainability into their strategies, operations, and culture to remain resilient and competitive. The transition to sustainable business models is ongoing, but further research is needed to clarify concepts, measures, and best practices. The impact of sustainability practices on corporate financial performance, literature trends, and future research potential by Ali Al-Shehi, Haitham Nobani, and Nilesh Kure, 2018, Sustainability, 10, 494. Purpose and scope. This paper systematically reviews 132 top-tier journal articles to analyze the relationship between corporate sustainability practices and corporate financial performance, CFP. It identifies trends, methodological issues, and gaps in the literature and proposes directions for future research. Key concepts and definitions. Corporate sustainability. Expanding the financial bottom line to include environmental and social dimensions, triple bottom line. Sustainability practices, actions taken by firms to address economic, environmental, and social responsibilities. Corporate financial performance, CFP measured by accounting-based, e.g., ROA, ROE, and market-based, e.g., Tobin's Q, stock price, indicators. Literature trends and theoretical frameworks. Competing theories. Value creation theory. Sustainability reduces firm risk and enhances long-term value. Value destruction theory. Sustainability distracts from profitability, pleasing stakeholders at shareholders' expense. Resource-based view. RBV unique capabilities in sustainability can create competitive advantage. Stakeholder theory. Meeting stakeholder needs, environmental/social, improves financial performance. Slack resources theory. Firms with strong financials have resources to invest in sustainability. Trade-off theory. Sustainability may reduce profitability if resources are diverted from core business. Empirical findings. 78% of reviewed articles report a positive relationship between sustainability practices and CFP. 7% report no impact, 6% report negative impact, 6% report mixed results. Methodology. Systematic content analysis. Articles selected from Scopus, ABDC, and other databases. Only peer-reviewed, English-language articles from high-impact journals included. Excluded articles focused on sustainability reporting, measurement, or integration without direct CFP analysis. Descriptive statistics. Publications classified by time period, country, industry, sustainability dimension, research type, journal, methodology, and financial measures. Results. Time period distribution. Research on sustainability and CFP has grown steadily since 2002, with a sharp increase after 2012. 75% of articles published in the last 3 periods, 2012 to 2017. Country distribution. The U.S. dominates the literature, followed by Spain, Taiwan, China, and others. Developed economies produce most research. Developing economies lag but are growing, notably China and Taiwan. Industry distribution. Most studies are multi-industry, 114/132, aiming for universal applicability. Manufacturing and hospitality are the next most studied sectors. Sustainability dimension distribution. Single dimension, environmental focus dominates. By combination, social, environmental, CSR, research is growing, often substituting for holistic sustainability. Total sustainability, declining in recent years, replaced by CSR-focused studies. Research type. Empirical studies dominate. Theoretical and literature reviews are rare but increasing. Journal distribution. 68 journals published on the topic. Journal of Business Ethics leads with 36 articles. Methodological approaches. Regression analysis is most common, 48/132. Wide variety of methods used, contributing to divergent findings. Financial measures. Accounting-based, ROA 53 articles, ROE 27, ROI, EPS, etc. Market-based, Tobin's Q, stock price, market valuation, etc. Market-based measures have increased since 2012, reflecting interest in long-term performance. Impact of sustainability practices. Positive impact is most frequently reported. Variation in results attributed to differences in methodology, financial measures, firm size, industry, and sustainability practices studied. Discussion and critique. Shift in literature. From single dimension, mostly environmental, to total sustainability, then to CSR, social, environmental. CSR research often underplays environmental and ignores economic dimensions. Measurement issues. No universal suite of financial measures for sustainability impact. Market-based measures complement accounting measures for future performance insights. Geographic gaps. Developing economies underrepresented, more research needed for generalizability. Methodological diversity. Wide range of methods and measures hinders consensus. Theoretical gaps. Lack of universal definition for corporate sustainability. Need for research to consolidate competing dimensions and synthesize understanding. Future research directions. Develop universal frameworks. Standardize definitions and measures for sustainability and CFP. Expand research in developing economies. Increase studies from non-Western contexts for broader applicability. Examine total sustainability. Study combined effects of economic, environmental, and social dimensions. Map financial measures. Categorize suitable financial indicators for sustainability research. Moderating variables. Investigate how firm size, industry, and economy type affect the sustainability, CFP relationship. Conclusion. The literature overwhelmingly supports a positive link between sustainability practices and corporate financial performance. However, methodological diversity, measurement issues, and geographic gaps prevent universal consensus. More research is needed to clarify definitions, standardize measures, and explore the impact of total sustainability, especially in developing economies. Title: Circular Economy Initiatives through Energy Accounting and Sustainable Energy Performance under Integrated Reporting Framework. Authors: Akil Hamza Al-Maktoum, Ahmed Jassim Al-Yassari, Raid Sayed Ali, Hassan Latif Kadim. Haider Nima Bikit, published in International Journal of Mathematical, Engineering, and Management Sciences, 2020. Purpose and scope. The paper explores how financial reporting, specifically through the Integrated Reporting Framework, can be used to measure and promote sustainable energy performance within the context of circular economy initiatives. It proposes a set of financial and non-financial indicators for assessing sustainable energy performance and discusses the limitations of traditional financial reporting systems. Key sections and insights. 1. Introduction. Rapid global economic growth has increased environmental concerns and the need for sustainable development. Energy conservation and emission reduction are central to sustainability. Traditional financial reporting focuses only on financial information and fails to capture non-financial aspects like environmental and social impacts. There is a need for a reporting framework that integrates both financial and non-financial information to assess sustainable energy performance. 2. Circular economy initiatives and sustainable energy performance. Circular economy seeks to conserve resources, reduce fossil energy consumption, recycle waste, and lower emissions. Energy accounting system. a new branch of accounting that tracks, analyzes, and reports energy use and its environmental impacts. Functions include energy management/control, treatment/prevention of toxic substances, and energy saving/emission reduction. Traditional accounting systems are inadequate for measuring non-monetary aspects like emissions, energy consumption, and renewable energy use. Energy performance measurement. Fossil fuels, oil, coal, natural gas, still dominate global energy consumption, but there is a slow shift toward renewables. Table 1 and Table 2 in the paper show global energy consumption trends and forecasts, highlighting the gradual increase in renewable energy use. Companies are key players in energy consumption and must adopt efficient energy accounting systems to manage energy use and reduce emissions. Sustainable energy system. Companies must balance profit maximization with sustainable development goals. Energy accounting systems help organizations manage energy consumption, reduce costs, and address indirect environmental/social costs. 3. Traditional financial reporting and sustainable development. Traditional financial reporting is profit-focused and records only monetary transactions. It does not disclose social and environmental costs, e.g., emissions pollution. There is increasing pressure, e.g., EU directives, for companies to report non-financial information related to sustainability. The current system is inadequate for measuring sustainability performance and risks. 4. Integrated reporting framework. The 2008 financial crisis led to increased demand for transparency and sustainability in corporate reporting. The International Integrated Reporting Council, IRC, was established in 2010, launching the Integrated Reporting Framework. The framework includes 8 elements: overview of the organization and external environment, governance, business model, risks and opportunities, strategy and resource allocation, performance, basis of preparation and presentation, general reporting guidance. Integrated reporting aims to provide a holistic view of value creation, including both financial and non-financial information. 5. Discussion. Performance indicators of sustainable energy. The paper proposes 16 performance indicators for sustainable energy, divided into 8 financial indicators. Total energy costs, TC. Production energy costs, PC. Saving in total energy costs, TCS. Saving in production energy costs, PEX. Energy investments, EI. Renewable energy investments, REI. Energy efficiency, EI. Remediation efforts, RE. 8 non-financial indicators. Energy consumption, EC. Emissions, YEM. Traditional energy intensity, TI. Renewable energy efficiency, RE. Total energy conservation, TC. Production energy conservation, PC. Energy management system, EMS. Renewable energy projects, REP. These indicators can be disclosed in the performance section of the integrated report, providing stakeholders with a comprehensive view of an organization's sustainable energy performance. 6. Summary and conclusions. The integrated reporting framework represents a major shift in corporate reporting, emphasizing both financial and non-financial information for value creation. Energy accounting is essential for sustainable development, but is limited by traditional accounting systems. The proposed indicators help organizations, regulators, and policymakers assess and strategize for sustainable energy performance. Adoption of integrated reporting and these indicators can improve transparency, consistency, and strategic decision-making for sustainability. References. The paper cites a range of sources on energy accounting, integrated reporting, sustainability measurement, and circular economy initiatives. In summary, This paper argues for the adoption of integrated reporting and energy accounting systems to better measure and report sustainable energy performance. It provides a practical set of indicators for organizations to use, aiming to bridge the gap between traditional financial reporting and the needs of sustainable development and circular economy strategies. Title: Corporate Social Responsibility and Financial Performance. Evidence from U.S. Tech Firms authors Anthony Okafor, Basi Ngozi Adelai, Michael Adusi. Published in Journal of Cleaner Production, 2021. Purpose and scope. This study investigates the relationship between corporate social responsibility, CSR, spending and financial performance among the top 100 U.S. technology companies listed on the S&P 500 index from 2017 to 2019. It uses quantitative analysis to assess whether increased spending on socially responsible causes leads to improved long-term growth and profitability. Key sections and insights. 1. Introduction. U.S. tech firms have experienced rapid growth and now represent a significant portion of market capitalization. Their activities have major social and environmental impacts, prompting calls for greater social responsibility. The study aims to empirically test whether CSR spending enhances financial performance in the tech sector, focusing on revenue growth, profitability, firm value, return on assets, ROA, and return on equity, ROE. Corporate governance is considered as a channel through which CSR may influence financial performance. 2. Literature review. CSR is defined as an organization's responsibility for its societal and environmental impacts through ethical and transparent behavior. The literature presents mixed findings. Positive effects. Many studies find CSR improves financial performance, stakeholder satisfaction, and competitive advantage. Negative effects. Some research suggests CSR can reduce financial performance, especially if it diverts resources from core business activities. No effect. Other studies find no significant relationship, often attributing inconsistencies to research design, sampling errors, or lack of control variables. The tech sector is less studied than manufacturing or finance regarding CSR's impact. 3. Theoretical background and hypotheses. Stakeholder theory. Firms should create value for all stakeholders, not just shareholders. Resource-based view. CSR can be a unique, hard-to-imitate capability that drives competitive advantage. Natural resource-based view emphasizes pollution prevention, product stewardship, and sustainable development. Hypotheses. CSR spending positively influences revenue growth. CSR spending positively influences profitability. CSR spending positively influences firm value, Tobin's Q. CSR spending positively influences ROA. CSR spending positively influences ROE. 4. Data and methodology. Panel data from 97 tech companies, 267 observations, were analyzed using content analysis, fixed effects, and pooled regression models. CSR was measured using the ISCSG rating score, which includes environment, employee relations, governance, human rights, climate change, and direct CSR spending. Financial performance was measured by net profit margin, revenue growth, ROA, ROE, and Tobin's Q. Firm age was included as a control variable. 5. Results of statistical analysis. Descriptive statistics. Average CSR spending was $46 million, with some companies spending up to $2.2 billion. Correlation analysis. No evidence of multicollinearity. Variables were normally distributed. Hypothesis testing. Revenue growth. Statistically significant positive relationship with CSR spending. Profitability. Climate change ranking was significant, but overall model was not statistically significant. Firm value. Tobin's Q no significant relationship. though CSR spending was marginally significant. ROA, mixed results. CSR spending and corporate governance were significant. ROE, corporate governance and CSR spending were significant. 6. Moderating impact of corporate governance. Corporate governance was found to moderate the impact of CSR on financial performance, especially for ROA and Tobin's Q. Effective governance enhances the positive effects of CSR spending. 7. Discussion. Increased CSR spending is associated with higher revenue growth and improved financial performance in U.S. tech firms. Environmental protection and climate change initiatives also positively impact profitability and revenue. Corporate governance is a key channel for leveraging CSR to improve financial outcomes. The study's findings align with some previous research but contradict others, highlighting the complexity of the CSR financial performance relationship. 8. Conclusion. CSR spending is fundamental to growth and long-term financial performance in the tech industry. Corporate governance enhances the positive effects of CSR. The study contributes new evidence specific to the tech sector, suggesting that strategic CSR initiatives can drive financial success. Results may not generalize to other industries. Future research should consider longer timeframes and additional variables. Key takeaways. CSR spending by tech firms is positively linked to revenue growth and profitability. Corporate governance strengthens the impact of CSR on financial performance. The relationship between CSR and firm value, Tobin's Q, is less clear. Strategic CSR initiatives can provide competitive advantage and attract investors focused on sustainability. This topic delved into the complex and evolving landscape of sustainability. We examined the challenges associated with defining and measuring sustainability, exploring alternative frameworks and metrics. The topic explored how organizations responded to global sustainability challenges, examining the interplay between economic, social, and environmental factors. We investigated the relationship between sustainability practices and corporate financial performance, including the role of ESG factors. Additionally, we explored the integration of energy accounting and sustainable energy performance within the broader context of sustainability. This topic will delve into the critical role of environmental, social, and governance (ESG) factors in modern business operations. We will explore how ESG can be leveraged as a powerful tool for enhancing risk management and driving sustainable growth. By examining the components of ESG and their impact on company performance, we will demonstrate how organizations can align their operations with societal expectations while maintaining profitability. We will discuss the evolving regulatory landscape surrounding ESG, including the SEC's focus on standardization. We will highlight the growing demand for ESG transparency from investors, particularly younger generations. We will emphasize the importance of robust ESG reporting and governance practices in building trust and credibility. This topic delved into the critical role of environmental, social, and governance (ESG) factors in modern business operations. We explored how ESG served as a powerful tool for enhancing risk management and driving sustainable growth. By examining the components of ESG and their impact on company performance, we demonstrated how organizations could align their operations with societal expectations while maintaining profitability. Furthermore, we discussed the evolving regulatory landscape surrounding ESG, including the SEC's focus on standardization. The presentation highlighted the growing demand for ESG transparency from investors, particularly younger generations. We emphasized the importance of robust ESG reporting and governance practices in building trust and credibility. This topic will explore the critical role of effective ESG strategy in driving long-term organizational success. We will delve into the importance of clear communication and measurable outcomes in building stakeholder trust. By examining the interplay between ESG and financial performance, we will demonstrate how organizations can capitalize on emerging opportunities while managing risks. We will discuss the role of technology in enhancing ESG data management and analysis. We will explore how platforms like Clarity AI can provide valuable insights to inform strategic decision-making. Title: Understanding the Impact of ESG Practices in Corporate Finance. Authors Sang Kim and Ji Chuan, Frank Lee. Published in Sustainability 2021, 13, 7, 3746. Purpose and Scope. This study investigates how environmental, social, and governance (ESG) factors affect corporate financial performance, including profitability and financial risk, credit ratings. It analyzes both individual ESG categories, environmental, social, governance, strengths and concerns, and aggregate ESG scores, using a large dataset of publicly traded firms. Key findings. 1. ESG and corporate profitability. Positive impact. ESG factors overall have a positive effect on corporate profitability, measured by return on assets, ROA. Firm size matters. The positive effect is more pronounced for larger firms. Governance dominates. Among ESG categories, corporate governance has the most significant impact on profitability, especially for firms with weak governance. 2. ESG and financial risk, credit ratings. General positive influence. ESG variables generally improve credit ratings, meaning firms with higher ESG scores are seen as less risky by credit rating agencies. Social factor most significant. The social component of ESG, e.g., community relations, diversity, employee relations, human rights, product responsibility, has the strongest positive impact on credit ratings. Surprising environmental result. The environmental score has a negative effect on credit ratings, possibly because firms with high credit ratings may invest less in environmental initiatives, or vice versa. 3. ESG integration for investors. The findings support the rationale for integrating ESG factors into investment management and portfolio construction, as ESG can help maximize value and minimize risk. Methodology. Data. Combine financial data from S&P Capital IQ, Compustat, and ESG scores from MSCI ESG Stats, covering 4,708 firms and 172,437 observations from 1991 to 2013. Variables: financial performance, ROA, credit risk, S&P long-term issuer credit rating, ESG scores, environmental, social, governance, and control variables, debt, equity, liquidity, size, investment. Analysis: multivariate regression models, split by firm size and ESG score quintiles, with fixed effects for firm and year to address endogeneity. Detailed results. Regression analyses show governance and total ESG scores are statistically significant predictors of profitability. Social ESG scores are the most significant predictors of credit ratings. The positive relationship between ESG and financial performance is stable over time and across industries. The impact of ESG is stronger in firms with large asset values and those with weak governance. Conclusions. ESG factors matter for both financial performance and risk, but the effects vary by ESG category and firm size. Corporate governance is especially important for profitability, while social factors are key for credit ratings. The study provides empirical support for ESG integrated investment strategies. Further research is needed, especially with more market-based variables, e.g., stock returns, equity risk, and improved data availability. Implications. For companies, investing in ESG, especially governance and social initiatives, can improve profitability and reduce financial risk. For investors, ESG integration is justified as a strategy for value maximization and risk management. For researchers, more work is needed to understand the channels through which ESG affects financial outcomes. This topic explored the critical role of effective ESG strategy in driving long-term organizational success. We delved into the importance of clear communication and measurable outcomes in building stakeholder trust. By examining the interplay between ESG and financial performance, we demonstrated how organizations could capitalize on emerging opportunities while managing risks. We discussed the role of technology in enhancing ESG data management and analysis. We explored how platforms like Clarity AI provided valuable insights to inform strategic decision-making. We concluded by emphasizing the need for a holistic approach to ESG that aligned with an organization's core values and purpose.